Hello and welcome to another episode of ET Market Smart Talk. Well, I'm your host, Kshitij Anand, and today we are diving into a fascinating and timely discussion: are traditional macro signals losing relevance in the bond market? Now, to help us decode this evolving landscape, we have with us Pratik Chan, CFA and Head of Fixed Income at Capital Mind Mutual Fund. Now, Pratik brings deep expertise in understanding market behavior, yield dynamics, and how investors can adapt to changing fixed income realities. Welcome to the show, Pratik.
Hi.
Great. Now, Pratik, let's just quickly, get your perspective from the macro space. Despite a supportive backdrop with rate cuts and rating upgrades, bond yields have risen. But what does this divergence reveal about the evolving trend in India's fixed income markets?
So you're absolutely right. So bond yields have increased, but it's not across the board. So what has
Okay.
happened is the curve has steepened and steepened a lot.
Hmm.
So you're typically your longer end of the curve, 15 years, 30 years, and those categories. Over there, the
Hmm.
spreads have expanded by almost from 15 bips to almost 75 bips. Whereas the shorter end of the curve, when I say shorter end, anything which is from 3 months to up to 5 years, it is down
5 years.
significantly. Yeah.
Mm.
So RBI, according to us, if you see the last three CPI number prints, on an average,
Uh-huh.
they are very close to 1.75%, which are like multi-year lows in CPI prints. So RBI actually missed the opportunity in their first October MPC, wherein
Mm.
they could go for a rate cuts. But
Mm.
having said that, we have a view that RBI might go ahead and cut 25 bips within this financial year. And rate cuts are also warranted because even in RBI's own projections for the next year, the first quarter projections of CPI is around 4%. And for the
Mm.
financial year 27, the first quarter projections are around 4.1. Even if that's the case, repo rate at 5.5 looks very rich, and there's a scope of rate cuts going forward.
Absolutely. Well, good news is that another rate cut of 25 basis point could be in the offing. Let's talk about a little bit on the inflation because you did touch about the CPI. Now, with inflation at multi-year lows but yields moving higher, are we entering a new phase? Where traditional macro indicators lose predictive power over bond trends.
Uh, yes and no. So we have to think in multiple aspects because as a central banker, RBI responsibility is multifold. It's not just
Right.
rates, it's stability of rupee. They have to see the global economics and they have to assess the impact of whatever the macro challenges India is facing. And credit where it's due, RBI has done a brilliant job in that.
Mm.
So when it comes to liquidity management, they are trying to keep liquidity very close to positive to neutral territory by using various VRRR, VRR tools available to them. And at the same time, they have defended rupee very nicely below 89 levels.
Right.
And now rupee volatility for the last few weeks or so is one of the lowest.
Mm.
And as a result, we have seen some FIs coming back. So if you see FIs have now started buying into Indian debt markets. Last
Mm.
4 months they were net buyers, and I think last month they were very close to 17 to 19,000 crores net buy in Indian debt markets. Also, we have to see globally there are issues. So if you see
Mm.
globally, the yields and the spreads between 10-year and the 30-year, which is the very long end of the curve, are expanding. And the similar thing is also happening in India. So, in general, bond investors are asking for a higher term premium for
Mm.
getting into riskier bonds. And they are coming out from a scenario where the rates were very low. And
Mm.
hence, the duration losses and duration risk were very high. Going forward, we can see this phenomena to continue globally and in India itself, so wherein the
Mm.
spreads between your 10-year and 30 years will expand.
Mm.
And the steep curves would be reality across the world. Uh, if you see, bond markets welcome the government move on reducing the issuance in the longer end, and we got a breather rally for a week or two. But now again, the levels are back. back to the higher spreads. And that is a structural issue for domestically, as lots of your NPS, EPFO, the increment money is actually going to the equities and not towards the long dated bonds. This is one of the factor. The second factor is state governments. State governments, which used to borrow generally between 7 to 15-year duration, of late they are targeting longer maturities. And hence they are crowding out Government of India also over there. These structural issues of pension funds and not finding the right kind of long-term buyers for the long-term securities, I think it's going to continue. And the spread between a 10 and a 30-year might continue to be at elevated levels. And having said that, GSECA will always provide for trading opportunities. And currently, I think the new benchmark, which is close to 645 levels, it's fairly higher than their long-term averages of repo, and definitely not factoring in RBI cut anywhere possible in future. So I think there's a trading opportunity in a curve, and let's see how market plays out.
Absolutely. And in fact, we saw a rate cut from the US Fed. We talked about rate cuts throughout the conversation. So how might the US Fed, potential dovish stance influence the trend in Indian bond yields and investor sentiment?
So for US, I will say it was something called a hawkish cut. So although what market expected a 25 bip cut, Fed delivered. But if you post press conference statement, if you see, the Fed chair said that the December cut is far from a reality. And having said that, the market reacted in a certain way, and 10-year US Treasuries are back to 4% and above. To be fair, US inflation is closer to 3% and above. And because of the government shutdown over there, many crucial macroeconomic indicators are not getting published. So actually, Federal Reserve is flying blindly. And having said that, next policy, December, might not be a live policy for Federal Reserve to cut rates. And they are also doing wait and watch. They'll wait for their unemployment numbers to come in. And per se, US economy is not doing that bad. In fact, many economists expected that inflation numbers to shoot up post the tariffs announcement. That we are not seeing in US CPI numbers yet. So it is uncharted territory for the federal banks and economists.
Absolutely valid point there, Prateek. And let's talk about a bit about the investor sentiment as well. What trend patterns should investors watch for to sort of identify entry or exit points in the long duration bonds amid the ongoing market recalibrations, could say?
So right now, even if we are expecting a rate cut, I would refrain people from investing into very long end of the curve. When I say long end, typically 15 years and above.
Okay.
Because idea is the spread expansion. You're going to make money when spreads contract, and spread expansions are here to stay, both because of the macroeconomic indicators outside India. And even if Government of India is managing fiscal deficit very nicely and they are always within the target and sometimes undershooting the fiscal numbers, having said that, there's a structural supply and demand mismatch in the longer end.
Sure.
So trading opportunities will come and go. And in that sense, active mutual fund manager would be in better place than a passive strategy, which is tracking some longer end of the curves, wherein the fund manager can come in and decide about the spread trading, getting into the markets. The current spread of 75 bips looks juicy, but you will not make money till the spreads are getting contracted. Yeah. So idea is to wait and watch, let the spread stabilize at certain levels, and then might take a fresh call. And these calls should be tactical in nature rather than part of your core investment or core portfolio, because idea is to trade in on this curvature of this curve, GSEC curve, rather than having a core position and sticking to that point on the curve.
Absolutely. Well, you did talk about the strategy about wait and watch at this point in time. But I'll still, probably throw my last question to you in case you want to add something. It's on the investment strategy. So, what would be an ideal investment strategy for investors looking to sort of lock in yields at current elevated levels?
So there are twofold strategies. One of thing is government of India security, which is longer duration, can give you as
Mhm.
good as 725 currently, right? If you want to lock in into very long term
Mhm.
levels, these are good levels to lock in. Repo
Sure.
at 5.5,
Mm.
long term G-Sets around 7 quarter. It's a fairly nice spread.
Mm.
But having said that, I will trend slightly differently.
Sure.
What I would suggest is in current markets, the 4 year corporate bonds are looking very nice. So
Okay.
typically your 3 to 4, 5 year corporate bonds is a safe
Uh-huh.
space. When I say a safe space, if RBI cuts rates, we can see a rally in this segment because this is the
Mm.
favorite for mutual funds and corporates alike. Lots of
Yeah.
natural demand is there in this segment. And
Mm.
in case there's no cut and market moves sideways, the current
Okay.
spreads of 80 bips on AAA corporate bonds are typically on the higher end of the curve, and that
Right.
should provide a safety. So on the
Mhm.
risk-adjusted basis, I think your around 4 year corporate bonds is one of the best-looking points on the curve right now.
Okay. So 4 year corporate bonds is something which is looking attractive at this point in time. That's a message coming in from Prateek. Well, this was fascinating deep dive, Prateek, and thank you for joining us and sharing your insights on the shifting dynamics of the bond market. Well, to our listeners, if you've enjoyed this conversation, don't forget you to sort of look at the text interview which will come out, and obviously the video part of it as the ET Markets Smart Talk for more expert perspective on the markets. Until next time. This is Shudha Janan signing off. Stay smart and stay invested. Thank you so much for your time, Prateek.
Thanks, Nitin.